By the time a global market opens, the window to capture an arbitrage opportunity is already closing. Procurement teams process thousands of price fluctuations before the first hour of trading is complete, relying on split-second analysis of raw data streams. Out of that daily noise comes a specific, highly concentrated intelligence brief. On August 4, 2026, Polymer Bazaar pushed their global feedstock update to subscribers. It arrives on a phone screen as a dense blast of characters. Naphtha, CNF Japan, 785-55. Propylene, USA, FDGC, 42.55, up. A rapid-fire cascade of acronyms, overlapping regional currencies, and isolated integers. A professional analyst reads these strings as a high-fidelity map of global industrial momentum for that specific 24-hour period. The first test of any junior analyst is taking this dense block of text and parsing the syntax into actionable macroeconomic intelligence. We can decode a spot market feed by applying this structural diagram, which breaks the text into 3 overlapping layers of data. The first layer is the chemical hierarchy. This maps the vertical relationship between the materials, tracing how base crude oil fractions flow down into finished consumer plastics. The second is regional nuance. Global markets are highly fragmented, and this layer translates the localized unit measurements, currencies, and volume weights used across different continents. The third layer is trade nomenclature. These are the 3-letter Incoterms embedded in the text that define the logistical reality of ocean freight and liability. A raw price means nothing in a vacuum. A trader extracts the true reality of the supply chain only when these 3 layers align perfectly. Looking at this supply chain pyramid, we start at the very bottom with the first line of the text update, naphtha. Naphtha is the fundamental hydrocarbon fraction. It is the raw, heavy base layer distilled directly from crude oil, from which the rest of the commercial plastics industry is synthesized. The August 4th data gives us a specific geographic and pricing anchor for this material, Japan, trading at $785. The critical signal is the modifier attached to the end of that line, minus 55. A sudden $55 drop in a single day points directly to an aggressive shift in the Asian market. It indicates either a massive localized supply glut at the ports or acute demand destruction, where downstream factories have stopped placing orders. Analysts track naphtha because a drop at the foundation is the earliest predictor of cost shifts that will soon ripple up into consumer manufacturing. As this diagram grows upward, we move one step up the hierarchy to the primary olefins, propylene and ethylene. The U.S. data reveals highly divergent market behavior. Domestic propylene is trending up, while domestic ethylene is trending down. When 2 chemicals in the same class, trading within the same domestic border, move in opposite directions, it signals mixed industrial momentum. Supply chains are pulling against each other. Tracking that momentum requires parsing the numerical units attached to these chemicals.
The U.S. reporting standard operates in cents per pound. Europe calculates trade differently, standardizing its reporting in euros per metric ton. Asia prices its metric ton in U.S. dollars. International traders maintain deep, automatic fluency in these conversions. Attempting to compare a U.S. figure of 42.55 directly against a European figure of 955 without calculating the exchange and mass difference results in a failed trade calculation. This stylized map tracks the 2- and 3-letter acronyms prefixing the regional prices. These are Incoterms. In the U.S. data, FDGC stands for Free Delivered Gulf Coast. This represents a domestic transaction via pipeline or rail, where the seller absorbs the transport costs. Contrast that domestic delivery with the European CIF and WE, cost, insurance, and freight to Northwest Europe. This price incorporates the variables of maritime shipping and the insurance premiums against ocean transit risks. The Asian data uses CFR, cost and freight. Here, the seller pays to get the cargo to the port of destination, but the buyer assumes all liability the moment the chemicals are loaded onto the vessel. A spot price is an incomplete metric without an Incoterm. A low per-ton cost is only an actual bargain if the buyer accounts for who holds the liability on the open water. Here at the top of our chemical pyramid, we ascend to the final layer of the data text, the specific derivatives, styrene, PTA, and MEG. These are the direct chemical precursors to finished consumer plastics. Their production costs are tethered to the upstream materials we analyzed at the base. The data shows absolute stability in the PTA market. The $880 price point is followed by NC, no change. That rigid flatline contrasts against the slight softening in the rest of the tier, with MEG dropping by 5 and Asian styrene dipping by 10. This points to a window of margin expansion. When a manufacturer's primary input cost, naphtha, plunges by $55, while their selling price for PTA remains fixed, their potential profit per ton increases significantly. This three-pillar dashboard organizes the fragmented data into a cohesive macro narrative for August 4th. The European market displays zero volatility. Every base chemical reported is completely flat, locked in a holding pattern. The US market is fractured by the diverging movements in its primary olefins. The Asian market is absorbing a severe upstream supply shock that has not yet cascaded into its derivative pricing. This 14-line update quantifies localized economic stagnation, divergence, and the delay between raw material shocks and downstream pricing. That raw feed is synthesized and published daily by Polymer Bazaar. Price is the fragmented data flowing out of the ports. Prediction is reading the spread between upstream naphtha and downstream derivatives to forecast industrial momentum. Profit is the result of executing logistics based on that structural knowledge. Mastering this daily syntax allows procurement teams to identify and act on shifts in the supply chain while they are still just a single line of text.